Yeah, I think 2019 has been a very political year. It's mostly the trade politics, I think, between the US and China that people worry about. I don't think that's going away. I mean, if you think of the US as a declining empire, China's a rising empire, there's always going to be tensions there. And I expect to see the market sort of deal with that over time. I do think there's a deal to be done, that China wants to give access to the financial markets. Its number one domestic policy is to institutionalize its own financial markets. And I think there's a deal to be done on intellectual property rights as well. But it's going to take time. It's not going to be simple. So it's interesting when we think about trade and growth, it's really not that important from a GDP perspective. And I don't think that the US can really isolate or contain China by using this trade tariff, this trade war method. China's reaching out across the rest of Asia, through Central Europe, now investing in Italy and Greece. So if the US tries to contain China or isolate China, it's really isolating itself from the rest of the world. The importance of trade is less about GDP growth. It's about how China manages an aging workforce, how it moves those sort of labor-intensive jobs into Southeast Asia, how it builds up economic relations with its neighbors, and how it just creates greater efficiencies. But it's not going to add much to GDP growth per se. I do believe that capital is going to be used more efficiently in Asia over the coming years and decades, and this is primarily China. Because if you think about China, it's gone from an economy that was really based on manufacturing, building out physical infrastructure. It's now moving into a service-led economy. And it wants to build all of the things that we're used to here in Europe and the US. It wants to build a welfare state. It wants to build a financial center. It wants its treasury market to be recognized worldwide as a safe place to park money. It wants the renminbi to be used as an international currency. It wants all of the efficiencies of a capital market to help support a pension system. And so it's been the number one focus. Better corporate governance, more efficient institutions around the stock market, building the trust both of international investors and domestic investors in the capital markets is so important for the Chinese. So it's interesting when you look at valuations, because if you look at valuations just using something like a price to earnings, and there Asia looks kind of relatively cheap compared to the US, about the same as Europe. But there's a big thing underlying that earnings number. If you look at the history of the last decade in Asia, it's been one where labor, the worker, has gained a greater share of economic growth. And that's totally opposite to what's been happening in Europe, and particularly the US. So what you've had in the US is expanding margins. In Europe, you've had expanding margins. In Asia, those margins have been crushed. So when you look at those valuations, they're actually overestimated in Asia and underestimated in the US. So I think that Asia, it's not just trading at a 20% discount, but when you think about normalized earnings, that's probably nearer a 30, 35% discount to the US. And it's probably at a discount to Europe as well. As for what's the most underestimated part of the market, it's probably the small and mid caps. You had 10 years in the first 10 years of this century where small mid caps did very well. Growth was strong. The last 10 years growth has been weak and the small and mid caps have lagged. I think that will switch back the other way. Yeah, we've just started to see appetite for Asian bonds. It was never really a category before. It was just emerging market debt. I think that people are starting to realize that within emerging market debt, Asian bonds actually are typically the better quality bonds, particularly when it comes to corporates. And if you look at spreads, worldwide corporate spreads over sovereigns, they're quite thin. In Asia, they're still near average levels. So that's probably where most of the value is in the bond market in Asia. If we look at just 2020, that sort of near-term time frame, and we look at financial markets around the world, I think the most important thing is how are those financial markets able to respond to slower growth in the US, probably slower growth in Europe, or even recession. And if you look around the world, they'd say that the US can probably react with traditional interest rate policy. Europe needs to have more quantitative easing or probably even coordinated fiscal policy, which looks somewhat tricky to achieve. In Asia, actually, it looks pretty well placed. Asian economies have big current account surpluses, very low rates of inflation. They're well placed to use both fiscal and traditional interest rate policy to offset this slowdown. And I think that's going to be the theme of the markets in 2020. So watch that core inflation rate. Watch the core inflation rate in China and the rest of Asia. As that starts to tick up, there'll be a big operating leverage and corporate earnings will start to accelerate very quickly.